complementing the residual rider basis, which remember was percentage loss. Okay? Very, very similar type of thing is also available in what we call partial disability. Residual tends to be more for the upper end market. Partial tends to be more for the basically blue collar workers, so that lower end of occupational classifications and everything. Okay, so partial is really quite simple. Just simply 50% of whatever you were entitled to. So if you were getting $3,000 a month, let's say, when you were totally disabled, now because you have gone back to work, they don't do calculation basically saying, oh, what's your earnings before, what's your earnings after. They just simply, because you have partial disability, they'll just simply say 50%. So 50% of $3,000, you get $1,500, and that's the end of that. Okay? It is quite possible, of course, to have on your same contract. It's quite possible to have residual as well as partial. So it's possible to have both riders. For the most part, they tend to be, like I said, higher end residual, lower end partial. But if asked, can you get both on the same contract? The answer is yes. You can actually qualify for both. Okay. One of the most popular riders to have these days is what we call return of premium rider, ROP. And you'll recall from different sessions that we've had in the past, okay, is that the idea of return of premium is that at the end of the day, the end of the period, whatever the case may be, okay, you're going to get all that premium back or a portion of that premium back. Well, disability insurance also has return of premium. But there are a number of different kinds, so you have to once again look at the material and make sure that you have the right definitions and everything. One of the most common one is if you have no claims whatsoever. So throughout that period of time, that you've been paying all this money, at the end of the termination date, let's say at age 65, whatever that the expiry date happens to be in your contract, you have had no claims whatsoever. Some companies will simply refund you 75% all premiums that were paid during that period of time. Okay. Some other companies may say if your claims were less than the premium, then we will refund you the difference. So, for example, over 20 years, you had claims of let's say $15,000, but you paid $30,000 in premium. The insurance company will basically refund you that $15,000, okay, because you already got the other 15 from your claim anyways. So if your premiums are basically your claims are less than the premium you made, you paid out, then you will get the difference will be refunded. Obviously, if the claims were more, then obviously you're not going to get a refund at all. So this is a sort of a double-edged sword. Is that if your claims are less than your premium, we give you something back. Okay. If your claims are more than what your premiums were, you're not going to get a refund. Okay. In all cases, whichever definition that you happen to choose, the point is that at the end of the day, when you get that refund, it is tax-free. Because remember, it is basically simply a refund of your own money. So there's no interest involved here. There's nothing along that. There's no investment component here. There's no opportunity cost. None of that stuff. Okay. Basically, it is simply that here's your money back, tax-free, whatever it is, and that's the end of that. Okay. Also, another provision that some companies will have, if along the way you cancel the contract prior to the expiry date for whatever reason you decide to no longer need it anymore, or whatever. So you have taken the initiative, you might say, to cancel the contract, but you have the contract for anywhere between 8 to 10 years or more. Okay, but certainly no less than 8 to 10 years. Again, read the contract, obviously. Some companies will refund you 70 to 80% of that of the premiums as well. So there is a cancellation ROP as well. So you can see this is extremely popular. All depends really very much on your particular needs, which one you want, and of course what the insurance company is going to be able to offer you as well. But it is a very popular basically option that you could have. And we'll see you next time.